afternoon, everyone. Thank you so much for joining another Barometer Readings webcast. I'm Pamela Hastings, Relationship Manager here at Barometer Capital. And joining me today, as always, is our Chief Investment Strategist and President of Barometer, David Burrows, who will be pleased to provide us with a brief overview of the market, macro view, as always, and provide a glimpse of what we are doing in our portfolios over the course of the week. We will be pleased to address your questions at the tail end of the conversation. So if you have some, don't be shy. You can email me at phastings@barometercapital.ca, or please feel free to ask a question on the Q&A or the chat via Zoom. And with that, on this beautiful fall afternoon, I turn the conversation over to our one and only David Burrows. Good afternoon, David. Great to see you.
Hi, Pamela. Great to see you too.
Thank you.
Thanks everybody for tuning in today. Here we are. It's the 17th of October. We're in the middle of that period when I know that we'll field lots of phone calls. Seasonally, it just tends to be the way that it is in the middle of October, and so it's a great time to have a call. I think that there's a lot to talk about. Clearly, people are worried. They see what's been going on in the Middle East, and that's obviously very, very concerning. It built on top of what's gone on in Eastern Europe, on top of concerns about much higher interest rates, and what all of that means and what risks that brings forward. I think that I always like to look at the balance of evidence as to what we see going on in the market and through some of our models to look at the overall health. As I always say, the market is like a giant machine. There's 1,000 moving parts, some of them really obvious, and they tend to get lots of coverage. And then there's lots of parts underneath the surface that have an impact as well. And overall, it's the combination of all of the things impacting markets that moves price. And so we like to look at a broad list of things and try and focus in on what is it that's behaving better than the rest. Where is their weakness? What do we want to focus in? Where do we want to avoid? And talk about kind of how that impacts our current positioning in portfolios. So without further ado, I'll kind of jump in just quickly from a high level. And what I want to do is just challenge sort of perceptions out there as to what's actually happening. So just quickly, I put this up on every webcast, long-term picture of the US stock market. And we know that there have been some long periods of outperformance where money works its way into the asset class where it's generally underowned after a long period of underperformance until ultimately it's overowned. In a structural bull market or a secular bull market, markets tend to do well for 13, 15, 18 years with interruptions, but it's sort of like 4 steps forward, 1 step back, cyclical bear markets along the way. And that's what we believe that we're in, even though, the last 22 months has been a difficult period. It is, at this point, from what we can see, a cyclical bear market, which may be getting close to running its course. Putting the last 2 secular bull markets under a microscope, we can see there have been a series of interruptions along the way. This one so far has lasted 22 months. We're still about 8% from the old highs, December of 2021. And you can see, though, October the 17th, and the S&P is up 2.2% so far on the month. That is not, I don't think, what people expected coming into the month. But it tends to be that October is a positive month. It tends to start weak and end stronger. And certainly that's interesting in the face of some really disturbing things going on in the Middle East. So if we kind of, go through the history, there tends to be sort of at least 10% correction over the course of the year, 2 or 3 5% corrections, a bunch of 3% pullbacks. We don't tend to get sort of 15% pullbacks every year. Once in a while, certainly we had one last year. And that's just interesting data to follow. As we sit, this is the S&P going back over the last couple of years. We saw the market make a low around the 6th of October last year. And we've seen a series of higher lows since then. And you can see as of the beginning of October, we pulled back to the bottom end of the trading channel that the S&P has been in since that cyclical low. The correction that we saw was a 1, 2, 3 wave correction. That's typical, and came right down to the 200-day moving average. So as we sit, we got to those lows. We've bounced over the last few days, despite some bad stuff going on geopolitically. And overall, things have been a little bit better. Seasonally, we talked about the fact over the last few weeks that it tends to be market bottoms out around day 200 from a business calendar standpoint. We're at about day 209. So seasonally, this is typically when we start to see a little bit of buying come into the market. It tends to be that people have fear going into October that maybe the numbers or the earnings aren't going to come through as expected. We're going into the earnings period now. So far, actually, the financials reporting have not been a disappointment. They've been coming in against numbers that have been taken down going into the quarter, but in general, the numbers have been decent and the reaction to the numbers has been not too bad. Now, this is the equally weighted S&P 500 represented by the RSP ETF versus the market cap weighted S&P. And this is something that we've talked about having been a concern all year long. The average stock has behaved very poorly relative to the index that's market cap weighted, because of course the top 7 stocks have had a really inordinate impact. In fact, if you took the S&P and took out the impact of the 7 biggest stocks, S&P is negative on the year. But we've been saying we want to see the equal weight start to do a little better than the market cap weight. In other words, the average stock to start doing better. We've had actually 3 days in a row now where we've seen some improvement, not really anything to make decisions based on, but certainly notable because we haven't seen that in a little while. Small cap stocks have really underperformed over the course of the year. And similarly, we're at a point where small cap tends to bottom. Now, we've been through a corrective period starting on the 26th of July and up to the 13th, which is Friday. The equally weighted S&P was down 9.5%. The TSX down on a total return basis, down 4.6. That's the Canadian index. The Canadian bond market, the aggregate bond market, down 2.2. The MSCI World Index down 5.5. The dividend achievers or high dividend payers ETF down about 9.6. And against that, through the course of the correction, I feel okay about how things have gone. Our high income or tactical portfolio down about 0.77. So far less than what's happened in the equity indices and far less than what's happened in the bond indices. So I think that's okay. When we look at the balance of our portfolios, our equity portfolio corrected about 2.8%, balanced about 1.8, long short down about 0.11, and our global portfolio down 7, which is a little more than we'd like, but has had a great 4 or 5 days since last week. Positioning in the market continues to be exceedingly light. When you've been through 22 months of a cyclical bear market, people who wanted to get defensive have probably had an opportunity to get defensive. And we can see that in the positioning in hedge funds where we have very, very light positioning in the market. Where you tend to have a market accident is when everybody's positioned the wrong way and tries to make a change very quickly. That is not the case today. And we've highlighted the fact that off the lows in October of last year, if this was the end of a rally, well, it would have been the shortest cyclical rally off a cyclical bear market that I can point to, both in terms of magnitude and time. So never say never, but the balance of evidence at this point does not support it. Now, through the course of this correction, if we take blended mandates of our equity pool and our income pool, or equity balance and income, or equity income balance and global pool, all of them down between 2 and 3%. Actually, very good day today, so that would probably cut that sizably, actually. But we always have to be cognizant of the fact that our job is to manage drawdowns and to do it effectively by staying away from parts of the market that have been particularly weak or holding some cash weight, which of course we've been doing. When we look outside the US, Japan continues to perform well. And I think this surprises a lot of investors. The Japanese index, certainly currency hedge using DXJ as an example, which is an ETF. has continued to march higher month by month, going back to 2020. And India also continues to behave well. Now, we highlight that because when global markets have gone for a long period of time where they've underperformed US stocks and then they start to outperform, that actually tends to be a bit of a regime change. And so we care because our job is to try to identify the markets that are underowned and maybe where there's some revaluation opportunity. And while we don't compare ourselves to Warren Buffett for sure, he comes at things very differently than we do. I do note that Warren Buffett has been a sizable buyer of Japanese shares over the last 4 months. Moving on to fixed income. We made the case that we saw generational low in interest rates in 2020, and rates have been moving up ever since. And that's really important to recognize because when you get these regime changes, the types of investments that works change. And you have to reposition a portfolio for a different type of environment. 40 years of falling rates have programmed investors to believe certain things are good investments and certain things are bad investments. Certainly, as interest rates were falling, bonds were a great place to be. But that has not been the case over the last, couple of years. Going back to midway through 2020, the aggregate bond index, which is a basket of various issuers and maturities and credit qualities, have been selling off, and we're now in the third year of decline. And as of today, we're basically right on the lows from a bond price perspective. We're on the highs from a yield perspective. It means that bond investors have suffered 3 years of decline. The TLT, which is the long US Treasury bond, again, right on the lows. So until some of this stuff changes, we're in a bear market, and you got to be really careful. It means income investors probably need to be looking at a different type of income-oriented security. And this is something that we've banged on about over the last 2 years, but something I feel very strongly about. When we look at the big asset classes, stocks relative to bonds continue to outperform. So the first thing off the top, we think from a productivity standpoint, equities more attractive than fixed income, despite the fact that what we're seeing going on in the world is concerning. Equities have been protecting investors better than bonds. When we look within the equity asset class, equity dividend growers, or companies that have shown an inherent ability to grow their dividend faster than the index, certainly have been a better investment than fixed income, and actually have done very, very well relative to the broad index. So a core belief and something that's built into our portfolios currently is we are very focused on dividend growers, companies that generate cash, more cash than they need to run the business. And certainly that makes them attractive in a world where the cost of financing is going up dramatically. We want companies that are more lenders than borrowers. Now, sadly, people look backwards. And so as they have been concerned over the last few years, they have been moving money into bonds, which has been painful, and out of equities. We think our job as managers are to use the balance of evidence to move investors into the asset class that makes sense given the current environment. So that moves us on to commodities, probably the most unliked asset class, and understandably so, because sold off from 2008 through 2020. Now in 2020, when rates bottomed and we started to see inflation pick up, commodities really started to rally. And then the Fed got serious, and so did the rest of the central bankers. And we saw commodities correct. Now, the concern, of course, has been, well, the Fed raising rates will put us into some kind of deep recession and choke off the demand for commodities. Well, while they've corrected, they have not corrected very much. And in fact, about 4 months ago, 5 months ago now, investors clearly started looking beyond the Fed tightening cycle and said, we think inflation and pricing power in commodities likely to remain above average because commodities are giving positive returns over the last 5 months, while both stocks and bonds have corrected. So that being said, people have repeatedly shown a willingness to sell commodities because they believe, looking backwards, owning commodities was a tough place to be. If we compare the broad-based commodities index against the bond index, 1, 2, 3, 4, 5 months in a row, commodities outperforming, and we think we've started the second leg of what is likely a 5-leg bull market. So when commodities start to outperform, it tends to go on for a long time. If we compare commodities relative to the equally weighted S&P, again, really underperformed through the last 10 years, made a turn in 2020, consolidated during the Fed's tightening cycle, and now commodities have started relatively outperforming. So in the period where the equal weight S&P went down 9%, the commodities index went down 1.5, and now has been moving higher again. So we continue to point to the fact that when commodities start to perform well relative to stocks, it tends to go on for a long time. We think it's in the very early stages. Nothing changing there. That's been the same for the last number of months. So let's talk data just for a moment. The Friday of the week before last, we had payrolls. The expectation that employment will start to weaken as the interest rate increases start to bite. Surprisingly, expected jobs created about 170,000, came out at 336,000, 160,000 payroll increase actually came in at 263,000. The first response was, oh no, bond yields are going to go higher and that'll be bad for the stock market. Let's not mistake the fact that a strong employment market is good for the economy and it's good for companies that are generating earnings. Now let's move ahead to today. Retail sales, concern about the consumer. And frankly, we've been concerned about the consumer. The survey thought that retail sales month over month will be up 0.3. They came in up 0.7. And when we X out autos, the survey said up 0.2, came up 0.6. Retail X autos and gasoline versus 0.1 expected came up 0.6. So to put a point on it, the smooth 6 months annual growth rate of retail sales is not showing at this point a weak consumer. Now, doesn't mean that that can't come, but at this point, this does not look like a hard landing. When we look at the evolution of the Atlanta Fed's GDP now, GDP estimate going forward, continues to be that people are looking for stronger GDP growth, not weaker. So it may be that at some point we see data that supports a recessionary call. We're not seeing it at this point. And so we watch for signs in the market, and we'll talk about that as we go along. So our job isn't to be everywhere. Our job is to target market leadership. We got to identify themes or areas of the market that are showing signs that they're being revalued favorably, that money's getting put to work, and we want to focus in those areas. When a sector comes from being out of favor to into favor, very often investors revalue the multiple they're prepared to pay over a long period of time. And when things start to improve, often investors are behind the curve. So you make money by finding companies that are growing their earnings, but you make more money if they're growing them faster than people expected. And that means they're willing to pay a higher multiple of earnings. So market leadership is really important to identify. Our second job is to recognize change, new leadership as it emerges, and old leadership as it recedes, so we can transition the holdings in our portfolios in a timely way. And in the event that there's nothing working, having a willingness and an ability to play defense or hold cash or avoid certain parts of the market. So everybody has a different approach. We have a tactical approach. We're getting paid to make sure that the portfolios stay in tune with the current market. So 3 basic pieces of the strategy. We have a top-down model that helps us to identify the right neighborhoods within the market to focus in, the sectors or themes that are seeing net inflows of capital. And those are the only groups we want to focus in. From a bottom-up perspective, we want to find securities within those groups that are good getting better. And so we have a series of tests that we look for in the income statement and the balance sheet that shows that things are getting better faster than people expect, and also that price is behaving better than their peers. In other words, the leaders within the groups, where we can find securities that meet our business tests in areas of the market that are seeing net new inflows of capital. That's where our portfolio should live. And then, of course, the third thing is it's a living, breathing thing, the portfolio. And our job is to make sure we stay in the things that work, and that we use our disciplined selling strategy to carve out the positions that have stopped working or sometimes don't work in the first place, so that we have a productive portfolio. From a top down, we're always looking for parts of the market that are seeing expanding breadth. What do I mean by that? If there's 100 companies in a group and the group has been out of favor, we want to watch for when the first couple start to perform better. And then when the buying starts to spread in a healthy market over time, a higher and higher percent of the securities should be participating in the move. Broadening, expanding breadth is constructive. Now, late in advance, often while the leading stocks continue to move higher, the weaklings start to fail. And while people focus on the leading stocks and they have the biggest impact on, say, ETFs that people are following from a price perspective, the weaklings have less impact, but it tells you if the weaklings are selling off, that the floor is getting thinner under your feet. And if things get bad enough, breadth can impact more and more securities until eventually you get to a point where almost nothing's working. So every cycle goes through positive and negative changes on various groups or sectors or themes. And our job is to identify sectors or themes that are seeing net expanding breadth, or maybe they're under-owned and we're seeing improvement. And on the other hand, you get to points where sectors are over-owned and overloved and probably overpriced, and we see deterioration under the surface. Our job is to step aside. And that way we keep a portfolio that gives us a good risk reward. Okay, so let's talk about the current world. As we were coming through toward the end of September, we highlighted that across most global markets, the percent of stocks in uptrends had been declining, meaning fewer and fewer stocks behaving well. We have some short-term indicators. The percent of stocks trading above their 50-day moving average had been deteriorating. The percent of stocks with positive weekly price momentum or upward trajectory had been narrowing. The percent of stocks making new highs versus new lows, narrowing. And the percent of stocks trading above their 150-day moving average, narrowing. Now, that was the end of September. Here on the 17th of October, 4 short-term indicators we look at have all turned positive for Canada, the US, and globally. And again, this week, the numbers moved further to the right, meaning an expanding list of companies trading above their 50-day moving averages. There's nothing other than money getting put to work that drives that. Now, when we look at the percent of stocks with positive weekly momentum, that's expanded as well. And the percent of stocks making new lows, even though it's still a very narrow list versus new highs, is improving. And then the percent of stocks trading above their 150-day moving average also improving. So we've seen some net improvement in the short-term indicators. We are waiting on some of the longer-term indicators, but there's some more information this week. When we look at the percent of stocks in the NYSE and uptrends, we know that since July, that has been weakening, and it weakened from 60% of stocks in uptrends to a low of 32. As we sit today, the number's around 35%. We've moved up about 3.5%. It takes a 6% reversal for us to move into a column of X's, which tells us things are getting better. Okay, well, that's not happened yet, but it's getting a little better. When we take the same approach to the S&P 500, we can say, yes, the percent of stocks in uptrends in the S&P 500 got to a low of 28%. You can see over time, when you get to 30% or below and things reverse up, the improvement tends to continue. And so we got to 28%. And as of yesterday, we got a 6% reversal in the percentage stocks in uptrends. It means 34% of the S&P are now in uptrends. It's moved up about 6% over the course of the last week. That's relevant. Last week, we mentioned that we saw some improvement in the NASDAQ 100. So these are things that we watch. Now, things that concern us, when the market made a bottom and then a year out, the market was higher, it tended to be that the percent of stocks making new highs was pretty good. Like in 2003, a year out from the bottom of the tech wreck, you had 23 or 24% of stocks making new highs. In 2009 into 2010, you got to the point where 30% of stocks are making new highs. As we sit today, only 2% of companies are making that new highs. It means it's still a very narrow market, which is part of the reason that as a firm, we continue to have about 20% of the average portfolio in cash as dry powder, looking and waiting for places to put money to work. From a sector perspective, as of the end of day yesterday, if we take all of the 41 sectors and put them on a distribution curve based on what percent of stocks are performing well, you can see two outliers. Oil, which is in capital letters, which means the percent of stocks in oil sector that are performing well is expanding. You see a lot of small letters where we haven't seen expansion yet. And you can see that between 54 and 56% of oil companies are in clearly defined uptrends. We define that using point and figure price charts. Insurance also has over 50% of stocks in uptrends. And if we look at the groups at the far right side here, meaning the ones that have the best breadth, oil service, aerospace, well, that's defense, that makes sense. Machinery, savings and loans and banks, transports, builders. These are all pretty economically sensitive names. And that has been the case going back over the last 18 months. There has never been a time where the more economically sensitive sectors weren't behaving better than the rest. So when somebody says to me, we're expecting a hard landing recession, I would say, well, the market clearly doesn't believe that. And that doesn't bear out. Now, on the other side of the spectrum, the most defensive sectors, the ones least economically sensitive, the ones that act most like bonds, are the worst. Electric utilities, telecom, healthcare. These are very defensive sectors. So until we see that change, we have to be focused in companies down here on the right side of the spectrum. And I think, these are groups that we've been most focused in. So let's talk about leadership. Energy has clearly been leadership in the market year to date. This is the Canadian Oil Producers Index. This goes back to 2017. We know there was a bear market that went on from 2014 through the lows of 2020. And we know that finally, after many years, we made new highs in the oil index in 2022. Then the Fed tightening cycle basically tamped everything down. And over the last 3 months, energy has once again started to rally. Now, of course, it makes sense that it would rally over the course of the last week. You got problems in the Middle East. I don't think anybody saw what was coming in the Middle East, but clearly energy companies are performing well. Now, why is that? Well, they're generating a lot of cash and stockpiles are exceedingly low. So demand has remained firm. Stockpiles are low. It makes sense that Brent crude is trading better than it has in several years. Now, we'll watch for a sign of change here, but there is no negative change at this point. Crude oil is behaving well, and the producers of crude also behaving well. I like to use Canadian Natural Resources as a poster child for why we care. When you come out of a bear market that's gone sideways for a long time, and you start making new highs, commodity cycle tends to go on a long time. Canadian Natural Resources share price in the last structural bull market in the 2000s went up 1,700%. Now, I'm not predicting the same thing. We don't predict the future, but we look for positive characteristics. We know that CNQ's share price basically went sideways from 2008 through 2020. During that period of time, pension funds, foundations, endowments, private investors alike all sold energy. In fact, it became the most unpopular asset to own. It fell from almost 15% of the index to a low of about 2% of the index. But we broke out to new highs in 2021. We consolidated through 2022, and we're now making new, as of today, all-time highs. So look, when this begins, it tends to go on for a long time, and the group continues to be under-owned. Imperial Oil looks similar. We could put up 20 companies that look the same. These are companies that are generating great dividends, great dividend growth, a lot of cash. They're buying back shares, and they're increasing their dividends. Now, I get told all the time, well, oil is going to go away. I put this up another week, but I thought I'd put it up again. I think it's just so interesting. When we look at sources of energy, the old sources of energies that we've used historically don't go away. The use of biomass or wood for energy hasn't gone away. The use of coal has not gone away. The use of oil has not gone away. We add newer and newer sources of energy, but it's going to be a long time before the need for oil goes away. So we want to own long life assets. Now, we talked a little while ago about uranium, and uranium had the same bear market that oil and gas did. And nuclear became very, very unpopular. Of course, new technology and small modular reactors makes it a lot safer. A lot of countries that have turned off nuclear power are having to turn it back on because they're concerned about the supply of carbon-based energy. And Cameco is a great example. On the first day that materials performed well in the summer of this year in June, Cameco made a new all-time high. And we said, when you don't have strength in a group for quite some time and you get one strong day and a company makes a new all-time high, it probably means it's the beginning of something. Now Cameco shares are up about $10 a share since then. I think that is probably the beginning of a bull market. And when we look at the companies that use uranium, this is a company called BWX Technology, one of the holdings we have in our equity portfolio. This is a company that's been running small nuclear reactors for the Navy since 1960. And they're in the process of trying to commercialize their small nuclear reactors for commercial use. Most recently, Microsoft talked about the interest in running their cloud-based technology fueled by nuclear power. So this is one that we've got a small position in. But across energy, companies are generating a lot of free cash flow, which means a rise in dividends, means share buybacks, and we think that makes it very attractive in a world where financing is expensive. So energy versus the equally weighted S&P 500. I've had people say, well, energy looks frothy. It's gone up a lot. Maybe it's too late. It's just reversing a downtrend that's been in place since 2008. So this is not the end of something. It is likely something that will go on for many years, and ignore this regime change at your peril. So lots of names to own here, both in the services and producers. So this is the largest position that we have as a firm from a sector perspective. Materials is an overweight, although it's a much smaller weight. We've seen a series of higher lows since the market bottomed in October of 22. And within this area, if we compare materials versus the equally weighted S&P 500, they've been strengthening nicely over the last 4 months on a relative basis, and there's lots of things to do here. Industrials. Part of the reason I think that commodities are attractive is because the world appears to be going through a move from a unipolar, Western-based, US-driven world to a multipolar world. It looks like there are countries like China and Iran and Saudi and Russia that want to challenge the Western bloc. And as a result, a lot of American companies, North American companies, are bringing manufacturing back to the US or to Mexico, and there's a lot of reinvestment going on in industrial capacity. This is the relative price strength versus the S&P. A rising line means the group is behaving better than the S&P, and industrials are an unlikely sector if we're headed into a hard landing. And there's all kinds of stuff within the industrial sector that looks interesting. Caterpillar is a good example, trading better than 90%, 91% of companies in the S&P over the last 52 weeks, certainly consolidated while the market had its corrective period. It's held in remarkably well, and it's a global powerhouse in supplying into the resource sector and, of course, the building sector and the infrastructure sector. Moving on from industrials, insurance just continues to perform well. So within the financials, this has been our core area of focus. Progressive had just a dynamite day over the dynamite week where we've broken out to new highs. We talked about this last week. That's on top of strength in companies like Fairfax Financial and General Re. On the banks, we still have a very narrow ownership. JP Morgan continues to act better than 82% of companies in the S&P. It's acted better than the banking sector. It certainly corrected over the last 4 months. Looks like it's making a turn higher here. We'll see. But our holdings in Canadian banks are a zero. This is the equally weighted bank index in Canada. made new relative strength lows today. Now, there at some point we'll see a turn, but clearly investors are concerned about the impact of mortgage renewals and potential credit loss that the consumer, who's pretty leveraged up, has some difficulty. Again, sometimes it's as important to know what you don't own as it is to know what you do own. Now, healthcare in general has continued to be a difficult space outside of the GLP-1 weight loss drugs. Lilly making new highs this week, continues to perform well. We think that the GLP-1 weight loss drugs could be a $50 or $60 billion market. And Lilly is having an impact on consumer staples companies where people are concerned about consumption of junk food, the medical devices companies where people are concerned that in the future people may not need as many hips and knees. We're not going to make reference to that, but we're going to focus on what's working, and Lilly continues to perform well, as does Vertex Pharmaceuticals, making new highs today, trading better than 90% of companies in the S&P focused on cystic fibrosis solutions. So you got to pick your spots. Now, one of the things that we like to do is when a sector's been really out of favor, like consumer staples, try to identify the companies that are behaving completely differently than the rest. We have a couple of holdings here which continue to perform well. This is all we own in consumer staples. Dollarama, which is trading within a whisper of a 52-week high, expected to have earnings up 22% 2024. And Couche-Tard, which of course runs convenience stores generally in gas stations, looking for pretty consistent returns here. Again, very close to 52-week highs. And we've talked about this one over the last little while, Bellring Brands, which sells protein drinks into Costco and Walmart, made new highs today and has had a great week. So there may not be many companies making 52-week highs, but we've got several. Now, on technology, technology is widely owned. I think people have invested in technology companies partly because they're most predictable. People never get fired for owning Apple or Microsoft or NVIDIA, and we own them. But I do continue to watch the relative price strength wane over the last 5 months. And we have taken down our tech exposure, which makes up 30% of the S&P in the 7 biggest companies. The XLK is made up of those big companies and just behaving a little weaker than it has recently. One of the companies that we're a little worried about, we do own, but watching closely is Apple. Their earnings growth has slowed. 2023 estimates to be up 1%, 2024 up 8%. We'll see. It's trading at 30 times earnings. This is one that we'll have to keep a close eye on. Outside of the core tech, cybersecurity seems to be performing well, and that would make sense given what's going on geopolitically. Rising relative strength, trading better than 90% of companies in the S&P. Communications continues to act well. That's basically Meta and Google. Telecom behaving very poorly. So when we look at it, we say, okay, got to be careful of defensives, and the utilities continue to be sloppy. We talked about how defensive securities really have had a horrible year so far, and they've been things to avoid. So what does it all mean? Energy continues to be our biggest weight at about 17% of total firm assets. The S&P is a 4.5% weight. It's a bigger weight in the Canadian market. So we have a significant overweight versus the S&P. We have an overweight versus the Canadian market, but not nearly as significant. Second biggest sector, our financials, largely insurance driven. We've built a small position in government bonds. These are short-term government bonds we would use as a source of cash to put money to work. And when you pair that with some short-term corporates and some cash itself, it takes us over 20%. Technology, now only 14% versus 28% in the index. Industrials are about an equal weight, and materials are about a double weight. On the other end of the spectrum, defensives, we're really not there. In fact, we've been short utilities. We have a short position in real estate investment trusts. We have a very small position in staples, which we talked about a moment ago, an underweight position in consumer discretionary, and underweight position in communications, largely staying away from anything that's telecom related. So staying away from the defensives, which would be the things you'd want to own if you were headed to a recession, but there's no sign of strength there. On the other end of the spectrum, the things that you would expect to get hurt if the economy were to slow down are the best performing sectors in the market. So from my standpoint, the balance of evidence is we have a stronger, more resilient economy than people think. The data and the market behavior supports it. When we look at how things are going over the last little while, in general, through a pretty, tough correction over the last few months, the various mixes of our pools are behaving quite constructively, certainly versus bonds and stocks. Last few things to think about. Dividend growth continues to be attractive versus high dividend paying stocks. And at the risk of repeating myself, it's important to remember that when rates started to rise in the 1950s, it wasn't that stocks went down and underperformed. In fact, when this took place, stocks started to rally relative to bonds, and they went up 5 times what bonds went up between 1951 and 1966. What does that mean? It means stocks went up 15% a year, bonds went up 1.6, inflation was 1.6, you got a 0% real rate of return in fixed income and a great return in equities. And the returns in equities were focused in dividend growers. Now, we don't think that income investors in general are focused this way. We think they got a lot of fixed income. I keep getting calls every day from clients wondering if they wouldn't just be better to put their money in a 5% GIC or term deposit. I think that would be very short-sighted. Dividend growers are showing their worth, and in our tactical income portfolio, we can go to any area that makes sense. And certainly, over the last 6 months, dividend growth has way outperformed the other cohorts. Last couple of things. I watch for signs that the market's headed for trouble, where you get a significant pickup in volatility, and we are yet to see that. We watch credit spreads, or the excess return a bond investor demands to take the risk to own a corporate credit. And both investment grade and high yield bonds are not showing stress. So we just have to remember, follow the breadth, understand the seasonality. And the seasonality is that October, since 1950, or over the last 20 years, or over the last 10 years, has tended to be a good period of time to be invested. We're seeing improvement in our short-term breadth models. It doesn't give us an all clear sign, which is why we still have some cash. But certainly, sentiment got very oversold and exposure got very oversold. And we think we're in a period where the risk reward is still pretty good given where we're positioned. So we worry about events, but we know that events don't tend to drive markets for long. As we sit, the market's improving and we're working our way through a cyclical bear market. If the models turn weaker, we will get defensive. But I think all of our job is to have process as to how to make decisions, not to make decisions emotionally. Now, short-term outperformance hopefully turns into long-term outperformance, and we'll continue to measure it and report on it weekly. Thanks very much for tuning in. And if you got any questions, certainly we can try and answer them.
Hey, thanks so much, David. The first question we have comes from Alejandro. He wants to know, looking at your view on the continuation of the secular bull market for the coming years, do you see an opportunity to invest in small cap stocks or using ETFs like the IWM as a proxy for the versus the S&P 500, the SPY?
Yeah, certainly, we watch for that opportunity. There's the IWM going back to late 2021. IWM topped out the beginning of November, before the large cap stocks rolled over in the end of December 2021. That was a bad sign. As a group, they've behaved a little better over the last couple of days. You're sort of holding the lows from March, holding the lows from December, but really not much above the lows from October. Now, seasonally, we know that the end of the year and the beginning of the year tend to be quite good for small cap stocks. I will note that within these cohorts, mid cap value has behaved a little better. So that's the mid cap 400 ETF. If I was going to be in a smaller cap security, this is probably where I would go in general. But, I think it's pretty early to be getting focused in this area. We certainly are watching. I do, as I mentioned, think it's positive that for the last few days, the equally weighted S&P has behaved better than the market cap weighted. I think that's relevant and important to watch, but we want to see it show up in the breadth data. And it's really not showing up yet. When it does, we will most certainly talk about it in the webcast.
Thanks so much, David. The final question here we have today is from Ted. He wants to know, how have preferred shares been performing and where do you see them going, David, in the next 6 to 12 months?
Well, now preferred shares are a bit of a ubiquitous term because we know that preferred shares have a preferred call on the assets of a company over top of the other equity holders, gives you a little more security. But preferred shares all have different terms. Some are retractable, some are redeemable, some are extendable. But if I just take the ETF that tracks preferred shares, it's not a pretty picture. So yields may look attractive, but if the capital value is falling, the total return doesn't look so good. So we'll wait and see. We don't own any preferred shares currently. I would say from a technical perspective, the break of these lows was not a positive thing. So whether we're looking at the aggregate bond index, whether we're looking at the long end of the bond market, whether we're looking at PFF preferreds, whether we're looking at infrastructure, none of the yield-oriented securities are performing well other than the dividend growers. So that's where we're focusing our attention. We think they've been very well stress tested going through a tough market. And that would be the place that we would be focused as income investors. We, of course, as a firm like Royalty Income, we've got our music royalties fund, which has performed remarkably well. We're actually looking at some other royalty related securities for our investors. But so far, we're being pretty careful with fixed income.
Thanks, Dave. We just had one additional question slide through, so hopefully you have some time to answer this. This question comes from a viewer who wants to know a little bit more about your thoughts on copper and copper scarcity.
Sure. So
Thanks,
look, copper is scarce and is likely to be scarce for quite some time. It doesn't mean it's not economically sensitive. So, as a proxy, I've watched this company very closely, Teck Resources, Tech B, which is really the largest new producer of copper in the world. Stock has been consolidating in a very tight band. The problem with any commodity is that you have, physical buyers that need the commodity to produce stuff, and you've got financial players that are making a bet, long or short, based on what they think the future of the share of the commodity price is. I tend to watch the producers for my market signal, and I would say that they are consolidating. So again, you can imagine if we break upward or downward out of this consolidation, we'll be talking about it on the webcast. At this point, we do have some exposure. If you look at some of the leading securities, Foran Mining is one we've talked about. It's acting really well. So this is an intermediate sized company. It's going through, has copper deposits that likely will build. I think that's quite interesting. So there are positives out there. First Quantum's behaved okay. We're watching, and we do own some. And the fact is that copper, like the rest of commodities, went through a long, difficult period, and we watch for it to break out one way or the other.
Thank you so much, Dave. That concludes the questions we've received this afternoon. So as always, appreciate your time. I know our investors and our viewers do as well. And I will leave you, as always, with the final word. Thanks again, Dave.
Look, we're going to keep doing these every week. It's a great discipline for us to make sure we're revisiting all the themes that we're focused on all of the time, which we do. That we, when something changes, recognize it and be prepared to do something about it. We're watching the groups that we don't own for signs that, breadth is reversing. The first groups that have turned higher were oil and semiconductors, interestingly enough, that tend to be a leading group for a tell on the economy. I think that's interesting. But we'll continue to report to you. If you've got questions that we're not answering, shoot them over to us or give us a call. We're happy to talk about it. We think it is a tricky environment. It's very hard for investors who haven't got a really broad spectrum of background knowledge. If we're making decisions based on just what's happened over the last few years, it's going to be a tough market to be in. So don't hesitate to ask us. We're happy to talk about it. And otherwise, don't hesitate to follow our Twitter feed at Barometer CA. See if I put it up there. At Barometer CA, we post regularly, and hopefully some of the stuff is useful. With that, Pam, thanks very much for hosting today. Thanks everybody for
Thanks,
tuning in,
David.
and we'll look forward to seeing you again.